Hey, Steve Saretsky here. As always, this Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. Obviously, different scenery in the background here this week. I'm away on vacation in Palm Springs for a wedding, so don't let that distract you. But getting into this week, I think there's a lot to discuss. I mentioned last week that you can sign up for the Saretsky report. That report is now available, so if you want to read that report, it's a comprehensive analysis on the Vancouver market, Canadian macro, graphs, charts, etc. So there'll be a link to that below where you can check that out and subscribe to it if you so wish. I've been getting a lot of media requests over the last week, a lot of comments, questions. Seems to be a very hot topic, polarizing perhaps. I posted some charts on Twitter on the Langley condo market, basically showing a chart of the inventory. If you look at the Langley condo inventory, the inventory increased in October by just under 400%. So inventory essentially quadrupled in 1 year. It is now at the highest. It went from the lowest on record, I believe, to the highest it's been since 2012. So a 6-year high all of a sudden in 1 year in Langley condo inventory. So you've had the inventory increase by about 400%. You've had sales drop by 37%, and it's no coincidence that we're now seeing prices roll over. You can see here the MLS benchmark, which has been decelerating. Basically, at one point showing a 50% year-over-year growth, is now showing 11%. But in recent months, that has turned down. It's funny because I had some realtors comment saying, "Oh, you're not a realtor in this area. You don't know our market." And so it's very simple to see. You don't have to be a local expert to look at a chart and say, "Well, your inventory just quadrupled in a year." To suggest that it's probably not a healthy signal to see sales dropping by about 30-40% and then your inventory quadrupling. And obviously the media is picking it up, all surprised and shocked that this is somehow happening. But again, this is very typical of housing booms, where you tend to get these large run-ups actually out in the Fraser Valley suburb areas, where basically people create stories that this is going to be sort of the next hot spot, next downtown. You get people speculating. You get a lot of new developers coming in. And that's really what we've seen in Langley, and honestly lots of the Fraser Valley. Is you've seen all this new construction going there. You've seen a lot more immigration moving out there because of the more affordable housing. And it is because of the run-up in prices, it actually has made itself more susceptible to market corrections. And as we're seeing the Vancouver housing market correct, you're seeing the Fraser Valley have an abrupt change in market conditions, and I think Langley really exemplifies that drastic change. So again, I don't think this comes as a surprise. I think that if you look at Vancouver, that is a market that's more where you get the big money, you get the high-rise condos, you get a lot more of the foreign investment in the city of Vancouver. Whereas the Fraser Valley, further out in Langley and Abbotsford, that's a much more local market that is dependent on credit conditions and accessibility to credit. And what a great segue to drop, I think, is very underappreciated, at least by the media. People that don't understand it. Huge changes to the home equity line of credit space, Canadian HELOCs. This growth has been exponential in the Canadian macro environment. Obviously with Canadian household debt now making up 100% of GDP, home equity lines of credit are a large part of that. I believe it was from 2000 to 2010. Home equity line of credit growth grew annually by 20%. It now makes up 13% of our GDP, which, if you look at the States in comparison, HELOC growth it peaked, I believe, at 4% running up into that housing boom. So we have 13% growth in home equity. This has really spurred Canadian consumers to continue to borrow and to spend money. And obviously, one man's spending is another man's income. That's a famous Ray Dalio quote, and that's this ability to basically tap into your ever-rising home equity has allowed Canadian consumers to basically fund their lifestyle, whether that's a new car, a boat, a vacation, or a second property. Home equity lines of credit have been huge. And so this new regulation brought in by OSFI, it's not official yet, but we know this was bought by the guys that brought in the mortgage stress test. They've now brought in this change to the home equity policy where basically, as a mortgage broker, as someone qualifying for a mortgage, what they were previously doing was they would qualify your ability to service these debt payments on what your outstanding home equity line would be, as opposed to if it's there and how much you can tap. So as a hypothetical, let's say you had a $200,000 home equity line of credit. Well, they would only test your debt service ability based on how much you had tapped on that home equity. So if you had a home equity line just sitting there and set up with a $200,000 balance or limit, well, the balance is zero. So we just ignore that. But now what they're saying, to me, it makes a lot more sense, obviously, is saying, well, the fact that you have a $200,000 sitting there, we're going to test you on the assumption of your ability to service that if you had tapped that $200,000. So what this is essentially going to do is it's going to reduce one's ability. You're either going to have to reduce the size of your home equity, or you're going to have to reduce the size of your mortgage in order to get in line with your total debt service ratio, because there's a certain debt service ratio that you need to hit in order to get approved. And so, what people were doing is basically saying, we'll give you a mortgage for $300,000, but we'll give you an ability to tap on a $100,000 home equity line here, and we'll just set it up for you. Don't draw it, but it's there as a if you need it. And that was basically the practice. And so now what they're doing is they're saying, well, that's no longer the case. We're going to assume that, if we set you up with a $100,000 home equity, even if you don't tap it, we're going to assume that it was essentially tapped up to the 100K. And this is going to how we're going to qualify your debt service ratios. So again, this basically, not to confuse people, what it does is basically reduces one's home equity line borrowing capacity and or your mortgage borrowing capacity. You're going to have to reduce one of the two. So, obviously we know how prevalent home equities have been. People have been using these to fund down payments on second properties. Using the home equity, you can basically tap a home equity line, roll it into your checking account for 60 days. As long as it's been in there for 60 days, they don't look further of where that source of funds comes from. So you can basically roll that into an investment property. And that's basically what's been happening for a good chunk of investment properties. But also a huge component of this is these home equity lines have actually been helping to spur and promote the growth of private lenders, mortgage investment corps, etc. What people were doing was saying, tapping a home equity line of credit at 4%, 4.5%. A year ago it was 3.5%. 4%, and they're lending it out to a mortgage investment corporation at 8 or 9%. Well, all of a sudden you have a 5% spread there. So they're basically banking on that spread. So you're tapping your home equity and lending it over to a private lender who's then lending it out to another subprime borrower. So this has been helping to fuel the growth of these mortgage investment corps, which will also come under impact from that. So I think this is a very underappreciated policy. I think it's equivalent to, you're trying to close the barn door before the horse has already left. This sort of policy should have been implemented a long time ago from OSFI. They're now implementing it at a time when consumer credit growth is at a 35-year low. In my opinion, this is probably not the time to be doing that, because consumer credit growth is already so benign that you run the risk of essentially running into a credit crisis by just completely locking off Canadians' ability to access that credit. It should have been done much before. You've allowed this debt to accumulate and now you're hiking interest rates. This is not the time to be completely shutting off credit, but this is what regulators tend to do. This has happened time and time and time again. It's like a pattern to watch. So very, very fascinating. I mean, what's happening in the mixed space is very interesting too. Basically, because of the stress tests, you're getting much better quality borrowers, where basically the rates actually aren't really moving up a whole bunch on the mortgage investment side. Like if you're going to a private lender, the rates aren't necessarily moving up because they're getting a better quality borrower, and all these mixers, so they're growing so big and they're trying to grow their book because they're all competing each other on these rates. And so despite the cost of the funding going up, i.e. in order to attract investor capital to fund the mix, they have to offer a more and more lucrative return on investment, right? So, I mean, if you can get a 5-year Canadian bond at 2.4%, that's a pretty safe investment. So the mix have to offer a better rate of return, right? So, despite the cost of funding for these mixed going up, the rates that they're lending out to these subprime borrowers are actually not really going up because they're competing on each other. So their margins are actually getting eroded. And what we're seeing is they're actually switching a lot from the construction side, the more risky construction side, where housing starts are rolling over in recent months. Peak construction is behind us. They are actually switching into the more conservative, I guess, sort of single-family residence, condo, etc., and they're demanding basically a lower loan-to-value. So there's more of a buffer there in case things do go wrong. And but it's interesting to see that their margins are getting eroded. So that space is extremely competitive right now. Yeah, very interesting. I think what's happening in the credit space, just to watch this again from sort of a larger perspective. Obviously, there's a lot going on in financial markets. We're seeing oil roll over. That has implications for this USD shortage, where basically, these emerging markets are dependent on, a higher oil price in USD, that US dollar income coming in and actually contracting as the price of oil falls. That creates basically, again, a shortage of dollars, a stronger USD. Very, very interesting to see how this plays out in the bond market, because again, obviously that impacts Canadians, but we're basically just seeing this really tightening of credit, not just in Canada, but again, globally from all these factors. And just to see OSFI come in with this tightening in the home equity space, I think is substantial. And unfortunately, because most people don't understand it, it won't get much media attention. But certainly the people in the finance, it certainly has the attention of the people in the finance space and the people that actually understand what's going on here. So very interesting stuff. We'll keep an eye on it. But this is one of the things that I was kind of looking at. They've been talking about it and talking about it and talking about it. And they finally went ahead with it, it seems like. So as of today, only 3 lenders, I understand it, only 3 of the big banks are implementing this policy, but it's expected on the pressures of OSFI that by the start of next year here in 2019, that all banks, big banks, will follow suit. And generally as that happens, credit unions keep a close eye on that. So that's all we got here today. Hope that video helped. Otherwise, see you next week.